easyJet rejected Castlellake's fourth takeover proposal on Thursday, this time at 650 pence per share, valuing the budget airline at £4.93 billion. The board called it an opportunistic attempt to buy the company on the cheap, and then, in the same breath, agreed to give Castlelake limited access to its commercial data. The contradiction is the story. A board that genuinely believed there was nothing to negotiate would not open its books. The concession is the signal that a price exists. The public language of rejection is a negotiating posture, not a closing argument. The shares tell a different version. After climbing 8% on Thursday to around 580 pence, easyJet stock is still trading roughly 10% below even the rejected 650p offer. That gap is the market's probability-weighted view. Either the deal fails entirely, or the final price is barely above 650p. Neither path justifies paying 580 pence today unless one of those assumptions breaks. The bottleneck is not the price. It is who can legally own easyJet after a deal closes, and whether Castlelake's proposed solution to that problem survives contact with European regulators. That structural question is what the 10% gap is pricing, and it is the variable that will move before July 5.
European aviation law requires that airlines operating EU routes be majority-owned and controlled by EU nationals. easyJet is subject to this rule even after Brexit because it holds EU operating licenses. Castlelake, a Minneapolis-based firm managing $36 billion in assets, cannot own the majority. Its solution, a holding structure, where two EU nationals, former Ryanair and easyJet executive Peter Bellew and aviation consultant Mark Breen, own 51% of the acquiring vehicle, while Castlelake and co-investors, including Brookfield Asset Management, hold 49%. easyJet's board called the structure opaque and said it presents no basis for assessing deliverability. That is not a rhetorical objection. The EU ownership requirement is designed to ensure genuine control sits with European nationals, not merely nominal shareholding. A structure where 49% of economic ownership sits with Castlelake, while 51% of voting rights are held by two individuals running small advisory firms in Saudi Arabia and Dublin, raises a question the articles themselves surface without resolving. If the rule can be bypassed this easily, what is it actually for? IAG Chief Executive Luis Gallego, whose British Airways competes directly with easyJet, said the EU's competition framework makes any imminent bid practically non-viable. That statement carries self-interest, but it also names the regulatory risk that has kept serious European strategic buyers from bidding. The absence of a European airline counterparty, a Ryanair or a Lufthansa group outbidding Castlelake, is itself a data point. It suggests the structural barrier is real enough to deter the parties with the clearest path through it. The buried assumption in Castlelake's case is that price resolves the regulatory problem, but there is no evidence in the pool that higher consideration changes European regulators' view of what constitutes genuine EU control. That assumption, that approval is a function of deal attractiveness rather than legal structure, is the one that must break for the deal to close at any price.
The easyJet board's £1 billion medium-term profit target is doing heavy lifting in its rejection argument. But that target has no fixed horizon, and the airline's own FY 2026 guidance acknowledged that full-year profit forecasts remained uncertain due to the Iran conflict's impact on fuel costs and summer booking patterns. The International Air Transport Association nearly halved its 2026 global airline industry profit forecast, cutting from $41 billion to $23 billion. That context matters. The medium-term case depends on fuel stabilization and travel demand recovery that the current environment is actively disrupting. The more defensible part of the board's valuation argument sits in its balance sheet. easyJet's 208 owned aircraft and high-value airport slots, particularly at Gatwick and other constrained European hubs, are estimated by the board at approximately £5 billion. Castlelake's $4.93 billion bid values the entire enterprise at less than the stated asset base. Even allowing for valuation haircuts on aircraft, the slot portfolio alone represents illiquid, scarce capital that does not appear in near-term earnings. The sleeper asset is easyJet Holidays. The division generated £450 million pre-tax profit as its own 2030 target and operates on a capital-light model that earns higher margins than seat sales. Airlines are structurally brutal businesses, capital-intensive, fuel-exposed, cyclical. A capital-light holiday business layered onto the same distribution infrastructure is a different economic proposition, and it is one that Castlelake's current offer prices at very little. Analyst Samuel Ziff of Oldfield Partners, an easyJet shareholder, said any new bid would need to be significantly higher. Goodbody's Dudley Shanley said the narrative had definitively changed. The company is now effectively in negotiations. These are not the same conclusion from the same fact. The genuine counter-evidence to the bull case. easyJet shares were only 394 pence before Castlelake's interest became public. The 47% run to current levels is almost entirely a takeover premium, not a fundamental re-rating. If Castlelake walks on July 5th, the shares revert toward pre-bid levels, erasing the gains of the past month. The resolution is binary. If Castlelake submits a firm offer on July 5th, the Yahoo family, still the largest shareholder at around 15%, becomes the deciding voice. Their silence throughout this process is the single most important unresolved variable. A family bloc that endorses engagement forces the board to negotiate. A family bloc that aligns with the board's rejection closes the deal before it opens. The confirmation that makes easyJet an entry setup at 580 pence is either a firm offer at or above 700 pence, accompanied by a credible legal opinion on the EU structure, or visible shareholder pressure from the Yahoo stake. The confirmation that makes the current price a trap is Castlelake walking away on July 5th with no firm offer. The shares would likely fall to the 400 to 440 pence range as the takeover premium unwinds. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.